Welcome to the Cardinal Commentary for the Canadian equity portfolios. It's a matter of when, not if, the Canadian economy will fall into recession. The Bank of Canada is raising rates aggressively to curb inflation, but in 60 years, the central bank has not lowered inflation this way without causing a recession. But there's no cause for alarm. Recessions are a normal part of the business cycle, and they occur on average every 4 to 5 years. A recession is, however, something to prepare for by having a plan that invests in industry-leading companies with strong balance sheets that can weather a recession. In some cases, these companies come out on the other side even stronger, as some of their competitors have fallen by the wayside. We believe this is a very good time to be a value investor. In the latter half of 2020, our investment team believed growth stocks were overvalued and value stocks were on the verge of outperforming. They were right. Here's portfolio manager Sheila Wilson-Cole.
So we see still some good runway for value stocks, and we began to see that towards the end of 2020. Just when you looked at the valuations for a growth stock versus a value stock, the spread between those two was just at very extreme levels. So much like a pendulum, when it swings too far one way, it does tend to come back the other way, and that's what we saw start to happen in late 2020, continued through 21, and we do expect that to go forward to continue. Part of that is, I think, investors, when we look back to 2021, fundamentals weren't as important. It just seemed like it was a lot easier to make money. You could just put into anything, and a week later, it would be up. So whereas now fundamentals are a lot more important. You want to make sure you're not paying too much for something, that you've got a good quality asset that is going to be around for years to come, and that you can take comfort that a year from now it is actually going to be at a higher price. So I think just the fundamentals, more emphasis on dividend paying companies means that going forward we should continue to see the value approach do well.
We're a big believer in Intact Financial. The Toronto-based property and casualty insurer has outclassed the S&P TSX Financials Index over the first 6 months of the year, 12% versus minus 12%. In its most recent quarterly results, Intact reported net operating income of $475 million. That's up 38% from a year ago, and a quarterly dividend of $1 per share. That's up 20% from a year ago. Portfolio manager Terry Wong says Intact has a solid balance sheet, and its management team has successfully grown the business during the pandemic.
They are the largest property casualty company in Canada, and because it's such a fragmented market, their ability to make acquisitions, make strategic acquisitions, grow their business has been quite stellar from a performance basis. And what makes it very attractive from a portfolio basis is that it's not really economically sensitive. Everyone needs insurance, whether it's house insurance, car insurance, and because of the short-tail nature of the insurance, they're able to reprice, premiums on a yearly basis. So if there are times when there's higher losses due to storms or accidents, that sort of thing, they can raise prices pretty quickly in order to make up that difference in the profitability.
Compare Intact to Shopify, the one-time darling of the TSX. Its shares have fallen by more than 70% this year, and it recently announced layoffs of 1,000 workers. Shopify does not pay a dividend. Our Canadian equity portfolios preserved capital in the second quarter. They were down 9%, while the S&P TSX fell more than 13%. We believe investors will look back a year from now and realize that the summer of 2022 was a fantastic buying opportunity for some great companies. Our companies have continued to pay out dividends since the pandemic started nearly 2.5 years ago. In fact, 9 companies raised their dividends in the second quarter alone, led by the Royal Bank of Canada at 6.7%, Suncor Energy at 11.9%, and Canadian Tire at 25%. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.